Hi everyone, this is a lesson on section 2.7, the role of government in microeconomics, and we'll be focusing on indirect taxes. So indirect taxes are taxes on the spending on goods and services by consumers collected by the supplier on behalf of the government. First, we'll look at the distinction between indirect taxes and direct taxes. So what do we mean by that? Direct taxes go directly to the government. When I get paid, I don't even get to see the portion that is paid in tax. It just goes, so directly to the tax office. Indirect taxes take a more circuitous route to the government. First, an individual will receive their income, then they'll spend that income with a business, and a portion of the price will be a tax, and the business then passes this on to the government. So the taxes, they get paid by us and they get to the government. It's just different ways of doing it. So why do we do indirect taxes? So the goal of really any tax is, or one goal can be to raise revenue. What does the government need revenue for? Publicly funded things like roads and rail, direct provision of services such as education and healthcare, and transfer payments to individuals. By charging a small percentage of the price of a good, as tax, consumers will continue to purchase and the government will receive money. When this is charged on almost every good and service, like the GST, which is 10%, the substitutes also increase in price, so it doesn't really change what people buy that much. But governments also use indirect taxes because they want to distort the market. So a general principle of economics is that if you want people to do something, if you want people to stop doing something, you tax it. So you alter their incentives. Classic examples of taxes being used in this way are cigarettes, alcohol, and something that we see a little is to limit congestion in cities. So this is a picture of London where they've put a tax essentially on driving into the centre of London. So less people do it. So we get more onto this when we look at market failure, and that's section 2.8. So that's why we do taxes. Now, we already know that a tax will shift the supply curve left, and we've been drawing the new supply curve as a parallel line, just like that. Now we learn that it's not always parallel. Firstly, they stay parallel when a specific tax is applied. So a specific tax is a fixed amount per unit, say $1 per item sold. So the producers are willing to supply less at each price as they have to give their $1 per unit to the government. The new curve is parallel as the vertical distance between the curves is the amount of the tax, and the amount of the tax per unit is always $1. So the vertical distance will always be the same. An example of a specific tax is the excise on petrol, which stands at about 40 cents per litre. So about 40 cents of every litre of petrol you buy is taxed to the government. We've got something different, which is an ad valorem tax. So it's a percentage of the original price. So this is written in italics because it's Latin. This is going to be of most use for your IAs. This part isn't strictly in the course, but it's a way to be more accurate when we're doing extended writing that we get drafts on, and that really needs to be specific to the content. So an ad valorem tax, the new supply curve will actually drift away from the original supply curve because it's a percentage of the new price. As the price rises, the amount producers pay in tax increases. So an example of an ad valorem tax is the GST. That's when 10% is added to the original price. So of course 10% of $2 will be 20 cents, but 10% of $10 will be $1. So the difference between the curves will increase as the price goes up. So we know how to draw the diagrams. We can draw the new tax curve and this fancy ad valorem one as well. But we need to know why we care about all this. So let's start with consumers. Can you please pause here and draw up a simple demand and supply diagram, no tax, and draw on the consumer surplus? This is revision for you. All right. As I'm sure you got, the consumer surplus is the area above the equilibrium price and under the supply curve. So this triangle here. Now let's see what happens when we put a tax on. Here we go. The consumer surplus shrinks. This shouldn't be a surprise as the price has gone up, and due to the law of demand, quantity demanded decreases. Consumers get to enjoy less of the product. Well, consumers get to enjoy less of the product, and the ones that they still do enjoy cost more. So they get less, they enjoy less surplus value there. They get hit from two directions. It costs more and they get less of it overall. All right. Now, what about producers? I won't make you pause and draw the initial producer surplus because you now know where that is. You know it's the other one. So it must be below equilibrium price and above the supply curve. But have a go at drawing what the change in producer surplus will be once there's a specific indirect tax added. So just pause and have a go. All right. Here is what happens. A common error here is to forget that producers, while the producers receive the extra money, so they take the higher price, they have to give that money to the government. So it's not really their revenue to keep. Their surplus actually shrinks. So effectively, the new equilibrium price, the new producer surplus only goes up to P prod, which is the difference between the price they receive from the consumer and the amount of the tax. That vertical distance between the curves is the amount of the tax, and that's what they have to give to the government. So they don't get to keep that. So they're not better off from that high price. So producers are much worse off. They receive a lower price and they sell fewer. So we can see the quantity has shrunk as well. All right, the government, how are they affected? The government receives the revenue from the tax, of course. So they get to do all those wonderful things that I mentioned earlier with the tax. And now we know that the vertical distance between the two supply curves is the amount of the tax. So the government gets this amount multiplied by the quantity sold, government revenue. Now, let's wrap this up. So we know the consumer and producer surplus in a free market. It's like that. We know what happens to these with the imposition of a tax. They both shrink. We also know where government revenue fits in, if it's in there. But there's still part of the original social surplus, so consumer surplus plus producer surplus, that's not accounted for. It's this triangle here. So this is the welfare loss to society as a result of the tax. So previously this was consumer and producer surplus, but now it goes to no one. It's lost. So the society is no longer allocating enough resources to the production of the good. So that's it for now. I'm sure you've taken productive notes and are ready to tackle something in class. Thanks.